Welcome to vTalkInsight, Allocator's Lens Daily for January 21st, 2026. Global markets are digesting a sharp jump in long-term bond yields, a simultaneous sell-off in equities, bonds, and the dollar, and a powerful rotation of safe haven flows into gold and other real assets. For multi-asset portfolios, the key questions now are how persistent this rate shock becomes, how it feeds back into earnings and credit, and whether gold and currencies are replacing government bonds as the primary hedges. In equities, conditions have swung toward risk-off, with the latest session delivering the sharpest drawdown since last October. The S&P 500 dropped a little more than 2%. The Nasdaq was down around 2%, and volatility finally responded, with the VIX breaking above 20. Equity risk is now better aligned with the stress already visible in rates and geopolitics. The decline is still tech-led, especially in software and other duration-sensitive growth names, and renewed tariff threats against Europe add another layer of uncertainty for globally exposed megacaps. At the same time, the move is not a simple dash for cash. Small caps, select healthcare and biotech names, energy and mining stocks, and value-oriented retailers are all showing relative resilience, helped by safe haven demand for gold and strategic minerals and by consumers trading down rather than stopping spending. For allocators, valuations and positioning are the swing factors. U.S. forward price to earnings multiples sit just above 22, while payroll growth has cooled, leaving an uncomfortable gap between market pricing and the underlying economy. Investor surveys point to very low cash balances and the strongest bullish sentiment in about 5 years, which makes the market more exposed to profit-taking or a sharper correction if an exogenous shock lands. Technical commentators also highlight a widely watched equity index level around 6,000, where option positioning could amplify any downside break. The earnings and macro backdrop, however, is not uniformly negative. Corporate profits are still being supported by a double-digit capex boom. Ongoing strength in U.S. consumer spending helped by recent tax measures and a nascent productivity story that could allow solid growth without a return of high inflation. Within technology, demand tied to artificial intelligence infrastructure remains extremely strong, from chips and data centers through to utilities supplying power, even if recent price action has been painful. Capital is also rotating from U.S. equities into Asian markets, with India, Korea, Taiwan, and selective Chinese technology exposure drawing interest as diversification away from U.S. policy risk. That combination of stretch valuations, concentrated positioning, and powerful structural growth themes is what makes the equity call particularly complex right now. In rates, the dominant story is a global bond sell-off led by Japan. Long-dated Japanese government bonds have seen an extraordinary move. 30-year yields have jumped sharply since Friday, and the 40-year bond has traded above 4% for the first time in its history, approaching what some describe as a forced standard deviation event. That shock, triggered by proposals to pause the sales tax and add meaningful new debt ahead of elections, has rippled through global curves. U.S. yields are being pulled higher in sympathy. 10-year treasuries are pressing toward a 4.3% handle, breaking out of the range that has held for months, while the 30-year is back near levels last seen in the summer. Investors are questioning debt sustainability across major economies, not just in Japan, and Japan's experience is being treated as a cautionary case for other highly indebted developed markets. The fact that Japanese long-end yields have briefly risen above German bonds underlines how unusual this adjustment is. Flow dynamics are amplifying the move. Foreign investors now account for more than half of daily trading in Japanese government bonds, helped by FX-hedged yields in the mid-single digits for dollar-based buyers, while domestic investors are net sellers amid uncertainty over Bank of Japan policy. At the same time, many expect U.S. Treasury yields to remain structurally higher because of heavy supply, a diminished hedging role for bonds and balanced portfolios, and the unwinding of the compressed term premium from the quantitative easing era. Against that backdrop, the policy outlook is more mixed. Markets still expect the Federal Reserve to cut rates roughly twice this year, and possibly more if labor market softness outside healthcare persists. Some see a benign disinflation path, pointing to falling rents, potential declines in healthcare costs, and a productivity boom that could allow strong growth without stoking prices. Others emphasize upside risks from fiscal stimulus, persistent AI-related capex, and tariff-driven cost pressures, which could keep the long end elevated regardless of what the Fed does. For allocators, the combination of a Japan-driven shock, structurally higher yields, and record inflows into short-duration products makes duration risk and curve positioning central portfolio questions again. In credit, the message from prices is still calm even as rates and equities flash stress. Investment grade and high-yield spreads remain tight by historical standards, reflecting solid corporate fundamentals and strong demand for income, but leaving little margin for error if growth disappoints or policy shocks escalate. Many managers are responding by leaning into higher quality issuers and keeping more liquidity on hand so they can react quickly if spreads gap wider. Flows underline this demand. Fixed income exchange-traded funds have seen record inflows over the past year, with a clear preference for short-duration treasuries and active income products. Investors want the higher all-in yields that come with today's rate backdrop, but they are cautious about taking too much duration risk in a market where the long end can move materially in a single session. Beyond public markets, private credit and private equity remain important parts of the story. Private credit has grown rapidly and offers diversification, but the extra yield over comparable public bonds has compressed, and the asset class has not been fully tested through a prolonged downturn, which puts a premium on careful manager selection. At the same time, private equity exits and M&A volumes have rebounded, improving liquidity for limited partners and supporting deal-related financing. Looking ahead, supply is a key swing factor. AI-related capital expenditure is expected to generate a surge of new investment-grade issuance in 2026, which could create technical pressure but also fresh opportunities in high-quality corporate credit. Deregulation in the banking sector, which is estimated to add a few $1 trillion of lending capacity, points to abundant credit availability, while policy proposals, such as a cap on credit card interest rates, highlight pockets of consumer credit risk. In aggregate, credit remains an important income anchor within portfolios, but one that is increasingly sensitive to both policy surprises and higher for longer yields. In foreign exchange, the current risk-off episode looks very different from the traditional playbook. Instead of stronger dollar and a rally in treasuries, the U.S. currency has been weakening against other G10 currencies even as U.S. assets sell off and yields rise. That pattern points to concerns that are as much about U.S. policy and fiscal direction as they are about growth, and it rhymes with reports of some European pension funds debating whether to trim U.S. exposure in response to tariff threats and rising geopolitical tensions. The yen adds another layer of complexity. Normally, a sharp rise in Japanese yields would support the currency, yet this time the yen is weakening even as long-dated Japanese government bond yields surge. Markets are pricing multiple Bank of Japan rate hikes over the coming year, although some observers argue that expectation is overdone. At the same time, the currency is approaching levels where authorities have previously intervened, and officials are issuing increasingly forceful verbal warnings, which raises the risk of actual intervention if dollar-yen pushes toward the high 160s. Safe haven behavior is also evolving. Traditional refuges like U.S. Treasuries and, at times, the dollar are not attracting the same defensive flows, while the Swiss franc and especially gold are taking on a bigger hedging role. In emerging markets, investors are favoring hard currency sovereign bonds over local currency strategies to dial down FX volatility, and in digital assets the boundary with traditional finance is blurring as large banks partner with crypto infrastructure providers and stablecoin issuers hold full reserves in short-term treasuries. Taken together, currencies are now a primary transmission channel for both Japan's bond shock and the latest round of U.S. Euro trade frictions. In commodities, gold and silver sit at the center of today's cross-asset story. Both have pushed to new highs, supported by persistent inflows from central banks, Chinese retail buyers, and Western exchange-traded products. Unlike the inflation spike of the 1970s, this move is being driven by a mix of forces: fiscal concerns, geopolitical uncertainty, diversification away from traditional safe havens, and, increasingly, questions about policy credibility. Safe haven flows are visibly rotating. During recent bouts of equity and bond volatility, investors have favored gold, silver, and the Swiss franc, while U.S. Treasuries and the dollar have struggled to play their historic defensive role. With the VIX now above 20 and stock-level correlations low, traditional equity hedges such as broad index options are seen as less efficient, and many allocators now treat gold as a primary hedge against sudden geopolitical shocks or policy mistakes. Beyond precious metals, demand is spilling into base metals and rare earths. Persistent geopolitical tension and higher defense spending are boosting interest in critical minerals, while the AI infrastructure build-out is driving enormous needs for semiconductors and electricity. Miners linked to strategic metals are outperforming, and utilities, historically viewed as defensive income plays, are attracting growth-oriented capital as they expand capacity to power data centers, even though local power shortages remain a binding constraint in some regions. Taken together, commodities are acting both as macro hedges and as enablers of long-term growth themes, giving real assets a larger role in cross-asset risk management than they have had for much of the past decade. To pull the threads together, cross-asset markets are grappling with a rates shock that started in Japan, an equity market adjusting from stretched valuations and crowded positioning, and a safe haven rotation that increasingly bypasses U.S. Treasuries in favor of gold, the Swiss franc, and other real assets. Credit still looks orderly, but tight spreads and impending supply from AI capex and bank lending leave limited cushion for macro or policy mistakes. Currencies are a key transmission channel, with a softer dollar, a vulnerable yen, and shifting reserve preferences highlighting the impact of politics and fiscal choices. At the same time, structural forces such as AI investment and resilient consumer demand continue to support a more constructive longer-term growth narrative. For allocators, the near-term watch list centers on the stability of Japanese bond markets, the path of U.S.-Europe trade tensions, signals from the Federal Reserve about rate cuts, and whether gold's expanded hedging role endures if volatility stays elevated. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.